AMPH claims a governance victory, but the raw voting data reveals a company deeply divided. The latest 8K from AMPH Pharmaceuticals reports a successful annual meeting, but the details are troubling. On the surface, the board was ratified and the auditors were approved without a hitch. But when you dig into the actual vote counts, a different story emerges about institutional trust. Let's look at the bull case first. The company has secured a formal mandate for its leadership. By approving Ernst & Young as auditors, shareholders have signaled a baseline of financial transparency. Furthermore, the adoption of annual say-on-pay votes creates a high accountability framework for management. This theoretically forces leadership to prioritize high-margin initiatives and tighten their operating leverage. If this stability holds, it reduces execution risk as they scale their specialty pharma portfolio. However, the bear case is where the real data lies, and it is quite damning. Consider the opposition to the directors. William Peters faced 11.8 million votes against him. Jacob Liao-Adedui fared even worse with 12.2 million votes cast in opposition. These aren't just a few disgruntled retail traders, this is significant institutional disagreement. Then we have the broker non-votes, totaling 4.44 million shares. That represents roughly 12% of the outstanding share pool simply not participating. In the world of corporate governance, this level of apathy often masks a hidden catalyst. Could it be a looming M&A deal or a potential breach of debt covenants? Even the auditor ratification wasn't a clean sweep, with 684,000 votes against. While small opposition to a Big Four auditor like EY is unusual and suggests accounting doubts, this is particularly concerning given the company's $150 million revolving credit line. If the balance sheet is fragile, these governance red flags become magnified risks. Now look at the compensation vote. 24.6 million abstentions were recorded. Combined with the non-votes, the annual say-on-pay promise looks more like a carrot than a mandate. The board may still be free to dispense outsized bonuses while cash burn continues. So, what is the investor verdict? The formal stability is there, but the foundation is cracked. The company has the legal right to proceed, but they lack the full confidence of their owners. This creates a high-pressure environment where any operational miss could trigger a shareholder revolt. For the long-term investor, the risk isn't just the product pipeline, it's the leadership stability. AMPH is operating under a microscope now, and the margins for error have vanished. The formal victory is a mask for a fractured base and a looming liquidity question. Watch the next quarterly report for any signs of a distressed down round or a sudden pivot. The governance mandate is a thin veil over a boardroom in turmoil.